I think the norm should be pre-approving a condo, right?
Just like you're pre-approving a buyer before you go take them out shopping, you got to pre-approve a condo.
Why go through that process when you can do it all up front,
Yeah.
right?
Now-
And the other thing you have to factor is the golden handcuffs, right? So think of how many homeowners are out there that have a below
Yeah, that's a good
4%
point.
rate, right?
That's a
so
good point.
that's what's keeping inventory locked.
Hello everyone, I am David Vasquez. We are back again with Dennis Vo, our go-to lender and all things real estate financing. So Dennis, thanks again for joining me and talking a little bit about the mortgage and lending side of the business right now.
Thanks for having me back. Appreciate it.
Yes, so I think it was more or less about a year since you were here
Yeah.
last time.
Yeah.
But really, not only do we want to talk a little bit, an update on the financing side, but we want to get into more specifically the new condo regulations that are being implemented starting, I guess August 3rd.
August 3rd.
They were just implemented now.
Yes,
So
absolutely.
a couple days ago.
Mm-hmm.
What is being implemented or what changes are coming to financing regarding condos? And again, this is strictly condos. Single family homes, nothing has changed.
Yeah.
But regarding the condo regulations.
So the borrower has to get formally approved and the condo needs to get formally approved. So what is different is before we were able to streamline the review process of the financial health.
Mm-hmm.
The full review now looks at the financial health of the condo project. So looking at the budgets, the financials, their ability to basically make reserves to be able to fund future renovations so that things don't kind of fall by the wayside. And obviously with Surfside that happened to prevent that from happening, because Surfside happened because they did not have enough funds to fund these renovations at structural integrity in order to basically—
They kept opting not to increase and fund the reserve to kind of kick the can down the road.
Absolutely.
Which is what led to the tragedy.
And a lot of owners are maybe reluctant to increase the dues because they don't want their monthly, cash flow to be increased. So now what's changing is we have to look at these reserves to just make sure that there's at least 10% allocated to fund any major repairs that may be coming down the pipe.
So a building has to have 10% reserve.
Yes,
Reserves.
correct.
What else are they looking at when they do these studies besides the reserves?
Not every project will have 10% reserves.
Yeah.
So we will look to ask for a reserve study to see, hey, listen, if you're not at 10%, how will you get to 10%? And that is known as a structural integrity reserve study.
Okay.
So
SIRS.
SIRS, right? And so SIRS, imagine a CPA meets an engineer. They review basically the entire project, factor the milestone reports that are coming in, recertifications that are coming up, and they look to see, based off of the projected life of certain things, what needs to be saved in order to basically have preventative maintenance and pay for these repairs anticipated, so there's sufficient funds. So they put them on a schedule that you need to save X amount of dollars to meet these reserve requirements for these future expenses for repairs.
The milestone reports, because you kind of said it really quick and I wanted to ask you about it. Milestone reports and the SIRS were like implemented probably 12 to 18 months ago. Relatively new.
Right.
Into like lending practices and just the whole real estate landscape. What is the milestone reports? And correct me if I'm wrong, it only applies to buildings that are 30 years or older, or maybe 25 years if you're on the coast.
Yeah.
Is that how it works?
So if you're referencing the structural integrity reports,
that's one thing.
Yeah, one thing. So to make sure that we hit that, because that's actually really important, is Florida implemented that in law, was requiring condos that are 3 stories or higher to get a SIRS. Why that's important is because it basically forces projects to start saving 10%. So by making it a mandate after Surfside, they implemented that after that happened.
DeSantis passed that.
Yeah, so once that passed, Florida condos are actually in better shape than a lot of other condos as a result of that mandate.
Right.
Because they're forcing them to basically save 10% to meet those major repairs that will be required.
And the milestone reports go hand in hand with the SIRS, I guess.
Yes.
Basically, the engineers and the accountants have to get it on the same page, and basically everything they have to have their ducks in a row.
Correct.
Which I guess, because the problem is we came from the basically no laws and no regulations pre-Surfside collapse,
Right.
and now they're like implementing all these laws. So we're kind of like in this growing phase where there's going to be a lot of pain to certain buildings, certain owners.
Right.
But once it's all, let's say, like fast forwarding 5 years from now, I think it'll make a better landscape for condos in the future.
Absolutely. Yeah, I think you hit it right. I think right now it's forcing a lot of condos to get these reserves in place,
Yeah.
again, to fund these things. So it's actually kind of forcing the saving habit to happen, right?
Correct. It used to be optional before.
Correct. Yeah, because again, owners don't want to raise their monthly assessments. So this leads to the next thing, which are you're seeing a lot of special assessments happen when we look at financial reports, right, of the condos, because they're saying, hey, if there's a shortfall to meet these reserve requirements, we are going to have to basically hit up the owners to increase their dues so that we make sure that we have enough to meet what the recommendation is on the SIRS, or what the recommendation is.
This leads me to the more relative question.
Okay.
How does this affect my buyers and my sellers? So let's start with the buyers first.
Yes.
Because I feel like, and I think you feel the same, this is kind of like a big media hype. This whole clickbait of like condo laws are changing, because for me it feels like a lot of this already kind of existed.
Sure.
And we've been operating this way already. What actually changes for the buyer?
What changes for the buyer is you're going to get a more thorough, deep dive into the condo and the financial health.
The lender's doing this.
We are doing this, correct. So
When let's say I have a client, we go into contract, you receive the contract, you're doing a deep dive into the finances of the condo.
correct.
Okay.
So the difference is before, on a limited review, we would have basically a questionnaire that's completed, and we did not necessarily have to review the financial health. We didn't have to look at the budget. We didn't look at the reserves, anything like
You
that.
would just go based on the condo questionnaire.
Exactly. Based off of that, the master insurance policy, the bylaws, the covenants, and obviously satisfactory questions on the condo questionnaire. So on a limited review, that was the pre-August 3rd. After August 3rd, a full questionnaire is required, which we were completing all along. But the difference is now we have to look at the budget and the financials to see if they're saving 10%.
Yeah.
So that's the big difference is before,
Verified. Now it's got to be verified.
it's got to be, yeah, we got to look at the budget to see, are you saving 10% and how do you get there, right?
Right.
So that's really the big difference. And to your point, I do think it's a lot of clickbait. We were kind of looking at this stuff already.
Yeah.
But now it's like, now the condo needs to be formally approved and just making sure the financial health of the building is okay.
But pre-August 3rd, there was even like, maybe you didn't have to verify, but there was always buildings that were warrantable buildings where you could qualify for a conventional loan as low as 5% down sometimes.
Yes.
And then there was buildings that, let's say maybe they weren't warrantable because maybe they had a reserves of 5%. Let's say they didn't reach 10%. You could still get financing in that building, correct?
Yeah.
You just can't get a conventional loan.
Yeah, we would do non-warrantable financing is available for projects that just do not meet the requirements.
Correct.
So,
and the same applies post-August 3rd.
Post-August 3rd, so if let's say for whatever reason, a project does not have 10% reserves, that is not backed and will be able to be sold to Fannie Mae, you can take it to alternatively financing with non-QM and finance it through there that maybe has more liberal guidelines that doesn't require 10% reserves. So there are options available outside of the box that don't necessarily meet Fannie's 10% requirement.
And then those maybe you're paying a little bit higher interest rate, I would assume, slightly, or not even.
The rate terms are slightly higher because, it's not as liquid as being sold to Fannie on the secondary loan market, right? So thinking, non-QM alternative financing is more, privately held, and it's not as liquid and easily, sold on the secondary market.
What are the buildings that will struggle with this new law? But I think it's just the same answer as always from before. The same buildings that have struggled prior are going to be the same ones that are going to struggle moving forward, which are the ones that maybe older buildings that never had their finances in order.
Yeah.
And now they're getting hit with huge special assessments, not only to make it structurally sound,
right,
but also fund the reserves. So some of these owners are getting hit with huge assessments.
Right.
But a lot of the, let's say, post-2000 buildings that are well managed, have reserves, and always have their finances in order, probably nothing is really changing on their end. I mean, correct me if I'm wrong.
Yeah. No, I think you hit it on the head. I mean, any project that may have been struggling to get to, the SIRS has really forced them that they have to get there, right? So like, that's part of the mandate, is forcing the SERS, the reserve study, so that they basically have to get to a point where they get their finances in order to meet the 10%. The projects that have been well managed, that have the 10%, they're going to be okay. And then there's another caveat to this, which is January the following year, that 10% turns to 15%.
Whoa,
so
I didn't know that.
So 15%
That's
is
going
going
to be the minimum requirement?
That will be the minimum reserve requirement. So 15 will be the new 10.
Oh, wow.
Yeah.
So then so HOA fees may continue to stay a little bit higher until that 50% is met.
Yeah.
Oh, wow.
The 10% at least reserves.
Right.
Right, this year, and then come January, it's going to have to get to 15%.
Right.
So a lot of HOAs are kind of on call right now and get, to wake up that they have to get their finances in order, because, if they don't get to these reserve requirements, you're going to have a project that's going to be a little bit more risky to lend to.
Yeah.
And your buyer pool is going to shrink, because you're going to have to do non-warrantable financing, which we discussed, which has higher rate terms, higher down payment requirements, versus somebody who is expecting to put 3% down as a first-time home buyer into a condo and wanted that conventional financing.
So how does a buyer, let's say there's a buyer, it's like, I want to buy a condo, I only want to buy it if I could buy a traditional conventional loan. How does that buyer find these condos?
So
because there's like a Fannie Mae approved list and unavailable is what they call list, right?
Right. So Fannie Mae has on their website, any project that has been formally reviewed or reported that it is ineligible. So it's ineligible. So you can plug in a property address and into, obviously Fannie's, central, database to just find out, hey, is this project warrantable? It's been previously reviewed. Or if it's on the ineligible list, why is it on the ineligible list? And you're seeing things such as the insufficient, insurance requirements, major repairs are on there, pending litigation. So there's a number of things that you'll see reasons why they're ineligible, but then you'll also see projects that are warrantable, good to go. Only the new insurance policy needs to be reviewed for financing.
I'm thinking in my situation, luckily most of the buildings that I work with are more newer buildings, more on the luxury side. For the most part, they have their financing in order, and they're newer, right? So it's not like they have these huge special assessments or anything like that. But let's say I'm getting a listing in a building built in the 1970s in Miami Beach, which there's a million of them.
Right.
What does the listing broker have to do, or what should they do to be proactively getting this information, to not waste time with a buyer that ultimately might not qualify?
Yeah, I think that's a really great point, because I find a lot of condo purchases, people are either flying blind into the transaction, or no due diligence is done upfront to know if the project is warrantable, eligible, or if there is a issue that there needs to be alternative methods for financing, right? Whether seller financing, non-QM financing, or a cash transaction, right? So leveraging a lending resource as a listing agent to maybe provide the budget, the master insurance policy, because the seller has access to that stuff, right?
Yeah.
So they can go to the board, get that information.
Typically, they only release it to the seller. So the seller does have to be proactive and ask for it.
Yeah, and if they do get that, provide it to a lending resource, they can vet it out to make sure that the insurance, meets requirements. And then the budget reflects 10% reserves.
If you're a seller in a condo building that is approved by Fannie Mae, that opens up your buyer pool significantly.
Yeah.
Especially if you're like in the non-luxury market, let's say like sub 2 million.
Right.
Because now people could buy just like if they're buying a single family home.
Yeah.
Which again, those buildings are rare to find,
right?
But they're out there.
Yeah. So an example is like, let's say a first-time home buyer wants to buy a project and just put 3% down, right? So they go in through the process thinking that they're going to get conventional financing, and ends up going through the process, they're under contract, they order the appraisal, they don't order the condo questionnaire until 2 weeks before closing, and then they find out that the finances are not in order and they cannot get 3%, and they have to go to non-warrantable financing.
20% down.
20% down.
Maybe 25.
And the terms are completely changed.
Yeah.
So why go through that process when you can do it all up front, right?
Not waste any time.
Yeah, nobody's spinning their wheels. So I think the one thing is doing the due diligence up front versus waiting through you're going through, because then you're just wasting everybody's time and money and spinning your wheels, like you said.
How do you see it affecting the market now moving forward? Like, do you think there's going to be a big change, or is it kind of like more of the same, just a little bit more thorough?
I think it's going to be more thorough in terms of the due diligence to review everything. So I think it's important working with a condo lending expert, or just basically agents who are just educated on this, and again, not flying blind.
Know how to navigate it.
Exactly, and just get it under contract and let it figure itself out, because you're going to set yourself up for failure. It's better if all parties are aligned up front to know, hey, this project is going to be able to get conventional financing, or we have to have this discussion now that we're going to do non-QM, non-warrantable financing because there's these issues that are in the project. And not to say the other thing is, just because it's on the ineligible list isn't the end of the world.
No.
Sometimes there's these repairs that are completed and an engineering report can be provided that shows that it's 100% complete and there's no safety structural issues. And then we can basically assist with removing it from Fannie's list with those reports.
Yeah.
So it's not the end of the world. It's just,
agreed.
We
it doesn't mean that like it's on a do not buy list just because it's not on the approved list, which I mean, I was doing a little bit of research and I saw that Fannie Mae in 2021 had just a few hundred buildings in all of Florida on the unavailable list.
Yeah.
And now they have over 5,000. So like they're really cracking down on the building's finances and everyone getting the SIRS and the milestone reports.
Right.
But yeah, I have a listing in a building in Edgewater, and we're closing out it on this unit actually next week. I represented the seller, but like they didn't have 10% reserve. They had 8.8% reserves.
Right.
So the buyer, she was getting a loan.
Yeah.
But she was a very strong borrower, and she didn't affect her because she still loves the building. The building structurally is perfectly sound.
Right.
And they're, with the SIRS, they're on track to reach that 10% like within the next 12 months. So she felt very comfortable.
Yeah.
And it slightly changed her down payment. So, I mean, minor things, right?
Right.
So like you said, it doesn't mean it's a no fly zone, but just have to be educated on it.
Yeah, and I think going back to how buyers can be prepared is working with a lending resource that can go both ways, right? Because if you are working with a bank, they can be, I mean, no knock on banks, but, a little bit more one-dimensional in terms of it has to fit the box in order to...
Otherwise, it doesn't work for them.
It doesn't work for them, right? So, but if you have a full-service lender that can go, hey, if it doesn't work this way, we can provide a non-warrantable option, and you have that conversation up front. It's like, hey, here's an option if this meets the Fannie Mae conventional rate terms. Here's what it looks like if it doesn't go that way. Obviously, we're going to try to do the best rate terms first, but if it doesn't meet the box, we have another outlet. So just so you know, you're covered both ways to get financing if needed.
So that's kind of like the main condo portion. But now I wanted to kind of just touch on overall market conditions. So what are rates at today? Like today is, what's the date? August 5th.
August 5th?
August 5th. So what are rates at today?
Yeah, I mean, Mortgage News Daily has, 6.75 for your top tier credit scenarios for 30-year fixed.
And we started the year in the lower half of 6.5, right?
Lower,
so we were like 6.3, 6.2.
Yeah.
So why have rates, we were all hoping rates to continue going downwards closer to 6.
We all were hoping. We were all hoping.
And like we were close. We were at 6.0 at one point, 6.1.
Yeah.
And then it shot up to like 6.7, 6.8.
Yeah.
A lot of it had to do with the Iran war. But is that really like the driving factor in all this, or is there like other external factors, or is it really just like the war?
Yeah, it's really driven by geopolitical headlines, which ultimately goes into inflation. Right. So think of inflation as gas for interest rates.
Right.
So I mean, no pun intended with the Iran thing. but with gasoline, with inflation, if it's higher, it's going to cause mortgage rates to go higher. So if oil prices may go up as a result of the geopolitical activity, it's going to ultimately drive the cost of everything up. That is correlated with that in the economy. So when everything goes up from a consumer price standpoint, you're going to have higher interest rates because you have to account for higher costs of things.
It's not like in 2022 and like maybe even early 2023 where there was a lot of fears of a recession. I don't feel that there's fears of a recession right now. I feel like the only reason why these rates are a little bit fluctuating, especially the last 3 to 4 months
Mhm.
is strictly just based on inflation fears because of the war.
Yeah. Yeah, and I think that also is why Kevin Warsh has a very conservative, you kind of don't know what the next move is on what they're going to do. The market is pricing in, potential for a rate hike by the end of this year. That could increase or decrease, but a lot of it is just driven by geopolitical headlines on what can happen and how oil prices just impact everything in inflation.
So are we anticipating more rate hikes, or what do we think? I mean, it's just so hard to predict because obviously one tweet, by the president could change things, right?
Right. Yeah.
For the good and for the bad.
Yeah. Correct.
Like peace deal done. Okay, great. Rates
Yeah.
go down.
Yeah.
New missile attack. Okay, rates go up.
Right.
So I mean, I know it's impossible to predict, but what are we looking at like in 6 to 12 months in terms of rates?
I think we're likely in a higher for longer because you're seeing that, rate hikes, again, one by the end of this year, and possibly more next year. So, we could hover around, 6.5 to in the high sixes, I would think, for the next year.
Which is crazy because we've been around this now for like, what, end of 2022. So we're talking about four years.
Yeah, it's the new normal is like the 6% band, and Fannie Mae has the end of this year for rates to end at 6.4, right?
Kind of like where we started.
Yeah, so we're kind of right where it is. So until
choppy, but hovering around the same.
Yeah, exactly. As long as it doesn't go north of 7%, right? But
okay, so that's actually literally probably the next question I was thinking is, what's like the number that you see in consumers that's like, okay, I'm putting this on pause, kind of like the number that kind of bends or like breaks the consumer. They bend, okay, 6.4, it goes to 6.8, I can still get it done, but what's the number that breaks and it's like, I'm holding off right now? Is there a number that you've seen that kind of, maybe it's a psychological thing too, that like kind of really deters them and everything starts to slow down?
I think it's been in the 6% range. So I feel like a lot of first-time home buyers have been kind of waiting, knowing that rates are higher, 6.5 to close to 7. People have been holding off, but that 5 handle seems to be that number where it basically has a lot of first-time home buyers coming back in, and every time a 0.25% drop, you're getting X amount of home buyers that are coming back in from an affordability standpoint.
Yeah, because I feel like when rates were like at 6 to 6.1 at one point this year, like there was a lot more
activity,
or at least people making the first step of like, let's get qualified and see what's happening.
Yeah,
it's interesting because we've been in the 6s for a long time, and I think like that 6s, it kind of is like the status quo now.
Yeah,
if it ever gets into the 5s again, I mean, at one point it will, who knows when.
Right.
I think we'll see a big push and a big demand for people wanting to take advantage of that.
Right.
And on the other side, I think if it goes, which is dumb, from 6.8 to like 7 or 7.1, it's not like a huge difference on your monthly payment.
Right.
But I think psychologically, it will deter people from like making any moves at 7. I think they will pause everything at that point.
Yeah.
Just to see how things play out.
Right.
Because I think at 7, people just get turned off.
Right. And the other thing you have to factor is the golden handcuffs, right? So think of how many homeowners are out there that have a below 4% rate, right?
That's a good point.
That's what's keeping inventory locked, because you have, over 60% of homeowners right now have a rate, below that.
The golden handcuffs, just so we're clear on what this means, because we see this a lot.
Yeah.
The golden handcuffs are all the owners that live in a home right now that they locked in a rate in 2020, 2021, or early 2022, and they have a rate of 2.5, 2.8, 3.2. Let's just call it under 4.
Under 4.
Under 4.
Beautiful rate.
And I talk to, probably on a weekly basis, owners, to at least weekly basis, every week.
Right.
Owners who like, David, I want to move. I've outgrown this house.
Yeah.
I need more space for my family.
Yeah.
But I have a 2.8% rate on it.
Yeah.
Where can I go and I'm not going to get killed? Because from when the time that they bought, they have a 2.8% rate.
Right.
Got it.
Right.
But let's say they probably bought it in 2021.
Right.
Prices for single family homes have not slowed down at all since 2021.
Right.
They've gone up every single year, 5, 6, 7, 10% at times.
Right.
So they're buying something much more expensive, property taxes much more expensive, and then interest rates probably double, maybe even triple, depending how low their rates are.
Right.
So and those are the golden handcuffs owners, which I guess in a way has kind of propped the housing market to keep appreciating, because that inventory that normally would come online is just doesn't exist.
Yeah, and I think that's why you're also seeing the rise of home equity loans though too, right? So people are sitting on record home equity.
Yeah.
They have these golden handcuffs. So what they do is they'll say, if we've outgrown the house, how do we make this work with what we got? Because we don't want to let go of the 2.875% rate.
Can we make an extension?
So you make
or
an extension, exactly. So you do these home equity line of credits that you can, give up to $500,000 in leverage to make what they have work for their family, their growing family, or increase in household size.
Yep.
Yeah.
I think that's mostly everything what I wanted to talk about today.
Yeah.
Is there anything else that you think I'm missing or that we didn't touch on that if I'm a buyer or if I'm a seller today? Because sometimes you do this every day, I do this every day.
Yeah.
So we for us, this is like automatic.
Sure.
But what should a buyer and seller be thinking about that maybe we didn't touch on, unless if we touch everything?
I just think that, as part of a pre-approval process, I think the norm should be pre-approving a condo, right? So, adding it as a
just like you're pre-approving a buyer before you go take them out shopping, you got to pre-approve a condo.
Yeah, I mean, it's kind of crazy to think about it, but the condo's a co-borrower.
Yeah. No, it's
so
true.
you gotta make sure that they have the capacity to pay back the in the future whatever these repairs that will be required, that they have the ability to save the money to make those payments.
Yeah, and for the most part, like brokers that are very active.
Yeah.
Like I know most of the buildings that are like, hey, these are trouble buildings. These are buildings that are good.
Right.
And then these are the buildings that like, they're not on the approved list, but like we can make it work. They're on their way up. They're getting out of like the hairy situation.
Right.
And there's certain buildings that I'm just like, don't bother.
Right. Yeah.
Disaster financially. So like, and then whether they listen to it or not, that's on them.
Yeah.
I made the warning.
Yeah. Yeah. And I think you do that correctly, because you don't want to spin your wheels at the end of the day, right? So do the due diligence up front so that everybody's aligned and knows what's the status of the building and what path is the correct path going forward in terms of how it's going to get financed.
Amazing. Well, thank you, Dennis. Appreciate your
Hey,
time.
I appreciate
as
it
always.
again. Yeah, thank you so much for having me. I always love rapping with you.
Yes, we'll link Dennis's information. If you have any questions on the lending side, his information will be on this video. And as always, thank you for watching. Stay tuned for more. Subscribe, like, DM, and reach out anytime. Thank you, guys.